Hey everyone, and welcome back to Simply Wall Street's Market Insights. My name's Michael, and today we're doing a check-in on the AI industry. The AI frenzy of 2023 and 2024 has cooled down and entered the show me the money phase. Earnings season has shed a lot of light on where we stand. So it's time for an update on the industry and a look at the companies successfully deploying AI, monetizing it, and the potential opportunities for us investors. If you'd like to dive into the main piece, check out the chapters below and you can see where we dive into it. Before we do that though, let's cover what happened in markets this week. Let's kick things off with trade. The US Court of International Trade just ruled that Trump's sweeping global tariffs were illegal. The court said he overreached by using emergency powers for trade policy, something they weren't meant for. This decision could derail his tariff agenda and throw a wrench into ongoing trade negotiations. But for investors, it's a short-term relief. The idea of less tariff risk helped boost stock futures and gave a lift to trade-sensitive sectors like semis, retailers, and automakers. Just don't get too comfortable because an appeal is on the way. Speaking of semis, Nvidia just dropped its Q1 results. And yes, they were still flexing. Despite taking a $4.6 billion inventory hit tied to China export bans, Nvidia posted a massive $44 billion in revenue, and their guidance was even better at $45 billion. The China market may be cooling, but global demand, especially from the Gulf region, is more than picking up the slack. AI hardware remains Nvidia's playground. The Chinese market might be slipping away, but the rest of the world is still buying in. Next up, energy. Nuclear energy, to be specific. Trump signed executive orders to overhaul the Nuclear Regulatory Commission, fast-track reactor builds, and revive legacy sites like 3 Mile Island. This is big news for uranium miners, nuclear utilities like Constellation, and tech firms hungry for reliable power as AI workloads skyrocket. With Europe also pivoting back to nuclear, this sector could be gearing up for a long overdue breakout. Now let's head underwater, quite literally. Trump's executive orders also gave the go-ahead for deep-sea mining in the US and international waters. It's a direct shot at China's dominance over critical minerals like cobalt and nickel. The metals company is racing to secure the first ever commercial seabed mining license. Yes, it's risky. Yes, ESG critics are circling. But if the licensing comes through, this could unlock a whole new mineral frontier. And over in luxury land, things are looking a bit less shiny. LVMH just waved a red flag. Chinese consumers are pulling back on luxury spending and favoring domestic brands. The company's pausing price hikes and feeling pressure across its portfolio. It appears that post-COVID luxury boom in China is running out of steam. Over in autos, Stellantis gets a new driver. After a 6-month CEO search, Stellantis has tapped former Jeep boss Antonio Filosa to steer the ship. He's got a very tough road ahead. US sales are down, tariffs are rising, and EV competition is heating up. Filosa's challenge is to make Stellantis matter in America again. Alright, now let's dive into the main piece. AI's evolution isn't just about flashy demos, it's about who's actually turning tech into revenue. So let's do a quick Q2 checkup on the AI value chain. According to McKinsey, there are 6 levels in the AI stack: hardware, cloud platforms, foundation models, MLOps, applications, and services. Let's walk through where each one stands today. Starting at the base with computer hardware, trends are maturing and questions are rising. Nvidia, TSMC, and Broadcom are still riding high. Big tech continues to pour billions into data centers, though the pace is leveling out. That means the market is maturing, and the questions now are all about valuation, competition, and margin compression. With Chinese players like SMIC stepping up chip production for Huawei, we could see real geopolitical headwinds, and maybe a challenge to Nvidia's dominance. As for cloud platforms, they are growing, but they ain't cheap. Amazon, Microsoft, Google, and even Oracle are all seeing AI-driven demand finally showing up in the numbers. CoreWeave, a specialist AI cloud provider, has grown revenue 10x in just 2 years. That kind of revenue growth doesn't come cheap. It's burning billions of dollars in capex, but it's also a pure play bet on AI infrastructure. As for foundational models, they're experiencing rapid growth, rising competition, and looming limits. The model wars are heating up. OpenRouter's data shows skyrocketing LLM usage, but also reveals just how competitive the field is. Big players like Google and Microsoft benefit from user access, while open source models are catching up quickly. The tools are becoming model agnostic. Users can choose their favorite LLMs across platforms like Copilot and Perplexity. But with rising compute costs, we might be approaching scaling limits. Eventually, being good enough might matter more than being the best. Moving on to model hubs and MLOps, they are critical infrastructure but with limited investment access. Behind the scenes, MLOps keep everything running. Tools like JFrog ML and GitLab's DevSecOps suite are helping manage expensive, sensitive AI workflows. Unfortunately for investors, most leaders in this space are still private, the likes of Databricks, DataRobot, and Kubeflow, though that could all change in the IPO pipeline. Next, there's the applications. Adoption is rising, but the killer app use case remains elusive. Microsoft's Copilot has racked up 33 million users, but considering Microsoft Office has over 1.5 billion users, we're still in the early innings. Meanwhile, ad tech companies like AppLovin and MobVista are quietly killing it with AI-powered engines. And AI is already embedded in areas like customer support and cybersecurity, just not always in ways that are easy to monetize directly. And then there's the agents. 2025 is meant to be the year of the agent. AI agents are meant to do things, not just suggest them. Think buying flights, signing contracts, or placing orders. Companies like Salesforce and ServiceNow are committing a lot to these tools. So far, they're not moving revenue much, but they are boosting sentiment and guidance. It's early, but this is something to keep a close eye on in the quarters ahead. Then there's data, which is digital gold with compounding strategic value. Snowflake performed well this earnings season. Why? Well, because managing data is becoming a massive differentiator. Salesforce just dropped $8 billion on Informatica for the same reason. Palantir's been on a tear too, with sales growth for 8 straight quarters. The takeaway here is that the more high-quality data you own, the better your AI can perform. There's a big advantage for companies like Meta, Amazon, Alphabet, Visa, and PayPal, who have heaps of high-quality data. And finally, services. There's high demand, mixed results, and overlooked potential. Consulting firms like Accenture, Endava, Kyndryl, and Grid Dynamics are helping corporations map out AI strategies. Demand is high, but results are mixed. The key issue is their revenue isn't recurring, so it's harder to project growth. That said, this sector might be getting overlooked while everyone chases subscription-based models. So what's the insight? Use AI as a lens and not just a sector. AI is touching every industry. It's no longer just a tech story. Going forward, every investment case will need to consider how AI could help or hurt a business. Some key questions for us investors are: 1. Can this company leverage AI to improve its competitive position? 2. Is the company at risk of being disrupted? And 3. Does it have a clear, effective strategy to adopt AI and stay relevant? Some moats could disappear. Some competitive advantages that have been solid for decades could disappear overnight. Software companies are particularly vulnerable, as a lot of tools can be replicated very cheaply. Adobe is a prime example. Its Creative Cloud isn't cheap, and a lot of content can now be created using tools available for free. But there are 2 ways to look at this. The company could be disrupted as new AI tools become available, and alternatively, if the same tools are available to everyone, creators have even more need for something that makes their work stand out from the rest. Adobe knows its market better than anyone, so it's still best placed to create the best content creation tools. But the company will have to navigate this transition carefully and make sure its tools really do stand out from the crowd. And lastly, AI adoption can be a key driver of earnings growth. All types of companies can benefit through higher sales and lower costs through implementing AI in their business, which ultimately boosts margins. Look at what Alphabet, Microsoft, and Meta have been able to do already just over the last 2 years to their operating margins. Alphabet increased theirs from 25% to 31%, Microsoft increased theirs from 41% to 45%, and Meta increased theirs from 28% to 42%. So make sure when you're looking at investments, you're using AI as a lens and not just a sector. And that's where we'll wrap up today's market insights. Whether you're eyeing Nvidia, tracking token usage, or just trying to figure out where the next AI gold rush might hit, remember, the money is not in the hype, it's in the execution. If you'd like to read more about these insights, check out the link in our description, which will take you to the full article. We'll be back next week with more market insights. Until then, invest well.